Hey guys, what's going on? It's Henry, and in this video I want to show you a strategy that I'm utilizing on Palantir stock. This is going to be called a covered strangle strategy, and it's really fantastic for small portfolios. It's also really good for medium and large size portfolios as well. Now, this strategy I'm utilizing right now, and I've actually been doing it for a few weeks now in my Discord community. And what makes this strategy really unique is it takes option selling to the next level. So basically, option selling is what I really love to do. I sell both covered calls all the time for passive cash flow, and I'm also selling put options. When I sell a put option, I'm basically trying to run the wheel strategy. So it's really as simple as that. I'm doing covered calls, I'm selling put options, and I'm running the wheel strategy because I think that's one of the best strategies. And I have a video on my channel. I have actually a couple of videos on my channel about the wheel strategy, which is essentially like a passive cash flow strategy. It's like a machine. It's like a system. You're buying stocks for the price that you pick because, well, when you sell a put option, you can pick a strike price. So you can pick 100 strike price and get in for that, okay? You can also do a covered call and you pick out your exit price, right? Because if you pick $120 and it goes past 120, well, you're going to lose that stock and get assigned. Not a bad thing. Well, right now what I'm doing is I'm doing something called a covered strangle. So let me explain to you step by step how this works. I'm going to show you the position that I have right now, and I'm also going to open up a new position because obviously I want to make examples for you guys because I know a lot of people learn through examples. So check this out. You currently see that there's a Palantir 16 and 14.5 strangle. Okay, so let me kind of draw this for you. Right now, Palantir is sitting at $15.15. Okay, so as long as Palantir is in the middle of the strangle, that's really good. But even if Palantir goes outside of this strangle, it's still completely fine. Okay, let me explain. First of all, what I'm betting on Palantir is that I think it's going to go sideways. If it goes up a bit, that's perfectly fine. And also if it goes down a bit, that's also perfectly fine. I decided that I wanted to use a strangle on Palantir because it is fairly range bound. Like if I go into Yahoo Finance and I show you what the chart looks like, because obviously technical analysis is really important. You guys already know in a recent video that I launched Technical Analysis Bootcamp. That's also in the description below. You can schedule a call there. And basically technical analysis is how I select my strike prices. A lot of people are confused. How do I get into the proper strike? How do I enter a stock? Well, if you go to chart right here, I'm going to show you a very simplified version. Sometimes I'll use candlesticks. I'll see if a stock has broken out above a certain range, and then it typically does gap down. So I'll just take a look at the candlesticks, but then I'll also just simply look at a line, right? This line chart right here will show you the price action of a company, okay, how it's been moving in its history. And I'm taking a very close look at Bollinger Bands because, again, Bollinger Band is one of the most important things that you can really look at. Bollinger Band tells you the tendency, the central tendency of where a stock is likely to trade within. So let me explain. If you're, obviously 5'10", your stock's going to be about 5'10". That's how exactly the Bollinger Band works. So right now, Palantir is in the middle of its Bollinger Band. As you can see on the bottom side of the Bollinger Band, it's at 1427 and the top is 1621. So I expect Palantir to stay within this band. Now it could exit this band, but that would be unusual. There would have to be some, earnings event or some bad news or some really good news. Either way, I think that the stock's going to trade sideways because, well, for about 3 weeks now, it's been trading sideways. And if you're watching this in the future, you can always just copy and paste the logic that I have that I'm teaching you in this video, and you can paste it for any other stock or any other time period in the future when you're watching this. But as you can see, actually, there seems to be a really good base and at like $15 and like literally 25 cents where the stock is literally at right now. Ever since Palantir really had this dip in August on some really heavy volume, like you can see right here, there's some pretty heavy volume, 3 days of really massive selling, just really big volume. So I guess a lot of people that were longtime bulls may have cashed out for whatever reason. They may have cashed out for a gain or a loss. Maybe they have lost confidence, but they ended up, basically cutting Palantir stock. And now it's still around, $15. So, I would be really surprised to see a drop below $14 per share. I think that the stock has crazy support, but also I don't think it's going to break out beyond 1633. So that's where the covered strangle strategy comes into place. I already have shares of Palantir. I have 400 shares and makes up about 0.69% of my portfolio. So I don't have a massively crazy position on Palantir right now. I could probably increase this position quite a bit, but one of my risk management rules is I don't really like more than 5% of my portfolio in any one stock. Of course, I'm breaking those rules with Apple, but then again, if I take a look at Apple, it's a huge diversified company, just a great overall stock. So I love Apple in many ways, and that's why I'm I'm ready to break some rules. Plus, I also consider Apple more like an ETF. It's such a big company, and it also makes up so much percentage-wise of S&P 500 as well as triple Q. So I'll break some rules for Apple. But for my Palantir position, I can actually increase it quite a bit, and I probably will. And something that you guys will notice right now is that my average cost on Palantir is actually $15, and that's because I ended up selling a put option. I sold a put option, I got assigned, so it's not a bad thing. People think that getting assigned is like really bad. It's not, it's perfectly fine. I like Palantir at $15 per share, so I got assigned and my average cost is 15, and I'm actually already up on the stock itself. So I'm up, $56, and then I'm up just a little bit on the covered strangle strategy here. So essentially, to run the covered strangle strategy, you're going to want to have 100 shares of the stock, because it's kind of very similar to a covered call. Okay, this might be a little bit confusing, but I promise it's not that bad. A covered strangle is just you're selling a covered call and you're selling a put option. Okay, now why would you do that? Well, let's say that I have Palantir at $15 per share. So I ended up doing a $16 covered call. So if it goes from 15 to 16, then I get $100. Okay, because from 15 to 16, I get a profit. Plus, I'm collecting some premium. So I collected some premium and I'm benefiting from 15 to 16. Now, if the stock falls from 15 to 14.5, okay, because that's my put option right here, you see, if it falls to 14.5, that's also not really a bad thing, because at 14.5, I'm ready to buy more of this stock. And if I end up buying more of it for 4 contracts here, I sold 4 contracts and I also have 400 shares, I'm actually gonna be dollar cost lowering, okay? So what that means is I have a 15 average cost, okay, 400 shares. Now, if I buy 400 more shares at 14.5, I have all of a sudden 400 shares at 15, 400 shares at 14.5, it's actually going to meet in the middle, and my average cost will now be $14.75. So now $14.75 would actually reduce my average cost. Plus, only one of these can happen, okay? Either 16 happens or 14.5 happens. Both cannot happen. It's called a mutually exclusive event. If it goes to 14.5, totally fine. I'm reducing my average cost. I still get the premium from selling the put, and I get the premium from a covered call. Now, in the other scenario, if it goes up, okay, I'll sell it at $16, but I get premium at the 16 covered call, and I sold a put option, so I'm getting the premium from a 14.5 put option. So I'm basically making money. Now, I basically want to show you what this visually looks like. I'm going to go ahead and open a position like this. Again, step number 1, you need to buy 100 shares of a certain stock. Could be Palantir, maybe it's Tesla, maybe it's another stock that you really like, okay? So you obviously want to like this stock because this is a bullish strategy. Bullish strategy meaning that you benefit if the stock rises, but this is a fairly neutral strategy as well, because if it just goes sideways, you're just collecting premium on both sides, okay? This is basically covered calls and selling puts on steroids, all right? I guess this is why this is one of my favorite strategies that I've been utilizing for a long time. It just never really showed up in Robinhood. Actually, let me just show you real fast. It usually doesn't show up in Robinhood as a strangle or a covered strangle, because I'm usually opening it up separately. So Robinhood doesn't realize that it's a covered strangle. For example, if I go to, let's just say Apple, I have Apple 175 put right here, and then you can see I have another covered call right here. So I'm pretty much already running this strategy in a lot of my portfolio, but it doesn't seem that way, again, because I'm not opening it up in one trade. If I was opening it up in one trade, then it's going to be realized as a 2 option strategy. So you see here, it says Palantir 2 option strategy. So let me click into this right now. Actually, let me go back to Palantir. Let me open up this position from scratch. You have 100 shares of the stock. You would go to trade Palantir options. First thing that you would do is you would sell a covered call. So I'm going to go to sell call option. Then I'm going to pick an expiration date. I'm going to go 30 days out. There's nothing wrong with 30 days. I like weekly trading. I like, trading every 2 weeks. I also like trading every 4 weeks. And the analogy I give is, would you rather make $1,000 per week or $4,000 per month? Well, of course, they're the same thing, right? It's an equivalent, right? So it doesn't really matter. And I like 30-day trading because the theta decay, the decay that this option is going down, is still really fast, and you have to do less work, and it's just really simple and it's really easy, and it allows you to work on the other areas of your life and not have to be a full-time trader, because I'm definitely not a full-time trader. I want to make this as consistent, passive, safe, and steady as possible, and I want to do it every single month. I don't necessarily want to day trade or anything like that, but I do swing trade a little bit. Either I use OptionsFi to get some ideas, or I'll look at candlesticks, or I'll look at some technical analysis. Sometimes I'll make some swing trades, but for the most part, I am more like a weekly trader to a monthly trader, okay? So let's just go for monthly though here, just for simplicity, 30 days out. You know, let's just say I have 100 shares at $15 or even 15, 14, okay? What I'm going to do is I'm going to sell a 15.5 covered call, and then that's it. I've sold a covered call, and now I'm also going to sell a put option, okay? So say my average cost is 15 or even 15, 14, doesn't really matter. I'm going to go ahead and now sell a put option. So I'm going to go sell a 14.5 put option. And what you'll notice right now is, you know, Robinhood is still thinking this is a custom order, but this is already called a strangle. So a strangle looks like this. Basically, you've probably seen this before. It's just a interesting strategy where you're gaining a lot of the money if the stock stands still, and then if it you know, has volatility to either side, you end up losing money. However, with a covered strangle, this is just a strangle. You really can't do a strangle like this because it involves unlimited risk, and that's why it says max loss unlimited, because it's a short call option. So if it's not covered, you don't have the shares. In theory, on the call side, it could go up unlimited amounts and you could end up losing money, which is why I wouldn't open this position in and of itself. What I would do is I would buy 100 shares and then I would open up this position. Robinhood doesn't realize, or right now it's not showing that I have 100 shares. So in the chart, that's not going to be reflected, but take my word, or call your broker, obviously have a conversation with them if you you know, want advice, because I'm not a financial advisor. But you know, what's going to happen is you have 100 shares and then you sell a covered strangle. It's going to be covered because of the shares that you have, the 100 shares. So it's not going to be an unlimited loss. You're basically just collecting $134 from this type of position, which is a really high amount, because the amount that I'm investing for 100 shares is about $1,500. So this is a very high return, $134. Now, if the stock goes up, okay, you will lose your shares. Yes, you can close the position yourself. You can just close one side of the position and close out the covered call, and then you wouldn't lose your shares. Then you would just have some shares, and then you would have a put option. That's fine. But in most scenarios, what I would do is I would just treat this as a standalone position, and you know, if it goes really high up, you can close it, but I probably wouldn't. I would just leave it alone. Of course, some brokerage accounts though, you have to be careful. They may treat this as a standalone position, so you definitely want to talk to your broker about that, because if this position goes up, they may decide to close out just a strangle and not the shares. So that could be, I don't want to say dangerous, because yes, you would lose money on the strangle, but you've made a lot of money on the stock itself. So it really kind of depends how you look at it. And overall, I think this is a really good strategy. As you can see, I'm not making like crazy amounts of money on this, but again, I'm not tying up a lot of capital. So if I wanted to increase the amount of capital that I'm investing with, then this would be worth quite a lot of money. And that's what I've been doing on Apple stock. And right here on Palantir, I'm up $16 so far. And I just opened up this position on the 18th. It's been 2 days. So, I mean, not bad, $8 a day for a very small amount of money. I'm very happy with this strategy, and I've been running it for a long time. So if you want to follow all my trades, then go ahead and click the link in the description. I actually have a technical analysis bootcamp, but also you can follow my trades in my regular Discord community. So up to you. Either way, I really appreciate a like on this video, a subscribe, and I will see you guys in the next one.